This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think.
Hey, Saretsky here. Welcome back to the show. Lots to touch on this week. We got some update from the National Housing Statistics released by CREA. We got some updates on mortgage credit growth, building permits, housing starts, and overall residential investment and how that's going to play into my thesis here moving forward. Because I think things are going to change as we head into the summer months, and I want people to sort of be prepared for an updated outlook on that. But, let's start off with the Canadian Housing Statistics. The latest release from CREA kind of continues to be, more of the same, which is what we've been talking about, which is I would argue the biggest story this year hasn't been demand or prices rebounding. It's been the lack of listings. Again, coming into this year, everybody was under the impression that higher interest rates were going to push sellers onto the market, push over-levered investors onto the market, oversupply of listings, inventory builds, prices come down. And we've actually seen the opposite, which is sellers have not been coming to market. Here in Greater Vancouver, 4 out of the past 6 months has seen 20-year lows in new listings, 4 of the past 6 months. And it's been a very, very similar trend on the national level. So we look at the updated data here in the month of May. New listings outside of May of 2020, which you remember was kind of the onset of the pandemic, outside of May of 2020, it was the fewest new listings in this country since May of 2009. So again, really hard, despite, interest rates going up, housing being unaffordable, really hard to get price corrections if there's no inventory coming to market. You need an oversupply. You need listings to outpace sales in order to push prices down. And so if you look at months of inventory, on a national basis, we're at 3 months of inventory for sale. The historical average this time of the year is 5 months of inventory. So you're sitting at 3, you're normally at 5. If you want a more significant price correction, you probably need to get to 6. And so this is kind of the dynamic that's playing out. And I get it, I understand it. A lot of people get frustrated and say it doesn't make any sense, just you wait. It's yeah, and that could very well change in 4, 5, 6, 8, 10 months from now. We could be talking about listings coming to market, oversupply. We could be talking about that. But the reality is, in this current moment, that's not what's happening. It's not what's played out. And so we have seen prices going up. Over the past 2 months, the home price index, which is a hedonically adjusted, smoothed out index, adjusts for volatility, is up 4% on a national basis. Basically prices have been climbing 2% a month, which again, if you start analyzing that out, you're talking about 24% annual price appreciation for the year. So again, is that going to continue? No, it's most definitely not going to continue. You're not going to get 20 plus price appreciation this year. But the reality stands that this movement over the past basically 5.5 months here to start the year, it has shocked a lot of people, myself included. And so again, like I said, the main big story here continues to be the chronic shortage of new listings coming to market. We've seen that rebound in sales activity, right? As people have seen prices rebalance, as people have had a little bit more confidence in the market that, okay, you know what, maybe the floor isn't going to fall out underneath our feet. You've seen them rejoin into the housing market. So if you look at resales, seasonally adjusted annualized home sales are 6%. They're only 6% below pre-pandemic levels of February 2020 now. So again, still long-term below sort of long-term averages, still not the greatest level of home sales, but you're 6% below pre-pandemic levels, which is not that bad when you consider the fact that mortgage rates are sitting at 5.2, 5.3, 5.4%. And you look at, this is a great chart from my friend Ben Rabideau, which shows the mortgage payment of a typical home in Canada. So if you were to take the MLS Home Price Index, so you take the National Home Price Index and you apply 80% loan to value on a 30-year amortization at today's prevailing mortgage rates, this is what your basically monthly mortgage payment would come out to, and it's obviously north of $3,000 right now. And so, that's a lot. If you go back and look from a historical contextual basis, this is not a cheap mortgage payment for the average Canadian. And so, the fact that we've got home sales only 6% below sort of pre-pandemic levels, despite the unaffordability that is rippling across this housing market, again, has surprised me. Now, I think ultimately this is going to be hard to sustain for very obvious reasons. And I think what we're seeing now is, as the data starts to change, as things play out, I think your opinion and your views should start to alter with that data, right? I mean, if you called the housing bust, it have been calling it since 2015, and in the process, house prices doubled. Well, you were wrong. You should have changed your thesis as the data started to come out. And so, I'm looking at it now and saying, okay, well, I wasn't really expecting the Bank of Canada to raise rates in June. I think they're probably going to go again in July. 50 basis points of tightening and mortgage rates creeping back up. I think that should change your view. And so I think that this is ultimately going to slow the housing market. Now, I don't think it's going to slow things immediately. Now, keep in mind, right, at the end of the day, there's people that need to, want to, have to transact in today's market. Inventory still remains low. Inventory as you go into the summer months typically does not grow. You just don't get a lot of activity in general in the summer. Sales, new listings. So typically the housing market on a seasonal basis will always slow into the summer. And so that's kind of what I'm expecting. And now there's two things here. A lot of home buyers aren't necessarily rational people. They don't necessarily think in a spreadsheet like a lot of our listeners here on YouTube will. And so I know, because I have these conversations on a daily basis. This is all I do every day. It's just basically help people buy and sell real estate. There are people right now that are trying to force through a home purchase before the rate hold expires. We've got clients right now on rate holds at 4.7%. As that rate hold expires in the next 6 to 8 weeks, that new rate could be 5.3%, 50 basis points, which again, when you're stress testing at 7%, could price somebody out of a certain bracket. And so we have people that are trying to expedite their home purchase. I've advised clients to be patient, be diligent, because we don't know. You could have two CPI reports over the next couple months that comes in with softer than expected inflation. Bond market reacts, bond yields fall lower, and we could be looking again in the fall with mortgage rates back in the 4s again. So these things, you never want to rush and force a real estate transaction, especially when you're talking about $1 million, $1.5 million, $2 million. These are massive, massive, massive investments, and so I would kind of caution people moving forward on that basis. But I think in general, the math still sticks out, which is I don't think 20-year lows in new listings is sustainable. At some point, we're going to see sellers retest the housing market. At some point, I think, given where mortgage rates are, inventory is going to start to balance out, and I think we're going to see some softening. And so I think that slowdown is coming here in the summer, and whether or not that persists through the fall is going to be the big question. But I think that there's still the obvious headwinds. And when we talk about obvious headwinds, all you have to do is look at mortgage credit growth in this country, currently running at 20-year lows in Q1 of this year, 20-year lows in new mortgage credit growth. And so you think about it, credit growth, credit is the lifeblood of the economy. It is what creates economic GDP growth in this sort of monetary system that we have, that we operate under. And so mortgage credit growth running at 20-year lows is going to slow things down from an economic perspective. And then all you have to do is look at what's happening on the residential investment side. We've talked about this a few times. Last week we talked about building permits, which are a leading economic indicator. Building permits in the month of April down 18%, their lowest levels since December of 2020. So future housing activity is going to slow significantly. Residential investment, we know that how much the Canadian economy relies on residential investment, right or wrong, it's what it does. Residential investment has plunged 15% on an annualized basis and is now down 20% compared to this time last year. So residential investments falling, building permits are falling, and now we've got an update here this month from CMHC showing the huge drop off in housing starts. And so all of this sort of construction and housing side, right? Like we talked about it at the end of the day, new listings are low, sales are still below pre-pandemic levels. So housing activity isn't really that, it's a slower housing environment in general, despite, yes, prices moving up, but in general, the activity levels are slower, and you're seeing this drop off in residential investment and new construction is ultimately going to slow the economy moving forward. So these things take time. That's going to take time. Mortgage and interest rates take time to filter through, right? 1/3 of Canadian households have seen a mortgage payment increase. Two-thirds have not including the people that don't even have mortgages, which is around 35% of the primary household. If it's your primary residence, about 35% of those households in Canada are mortgage free. So there's a huge cohort of people that haven't had interest rates actually come and filter through onto their balance sheet yet. So, suffice to say, I think that, the YouTube and Twitter sphere is always dominated by two views, which is it's either housing is going up double digits a year or housing is going to immediately crash 50% tomorrow. And there's no in between. There's never any in between. So what I'm here to tell you is I think there is an in between. I think over the next, 3 or 4 months, which I have a decent outlook on, inventory is going to remain tight, but I think demand is going to I think it's going to slow, given the sudden uptick, not only in the Bank of Canada rate, but in general bond yields pushing mortgage rates higher. That's going to take some wind out of the housing market. And this was not sustainable, right? I mean, we can all agree, bidding wars, national house prices rising 2% per month is not going to continue, right? You're not going to get 20% price appreciation this year. It wasn't sustainable. It was a nice sugar high. And so I think we're gonna level out here. We're gonna soften out over the next 3 or 4 months, and then again, we'll continue to update this channel because in 3 or 4 months I might have a new outlook and say, okay, based on the incoming data, this is how we're viewing things, and so. I think there's, someone that's in the buyer's market right now. I think patience is important. I think that caution is warranted moving forward. And I think for sellers, there was a great opportunity that people had in, March, April, May. And I think that opportunity is coming to the end as we head into the seasonally slower summer months. And I think as these headwinds continue to build up until mortgage rates can come back to more sort of, lower sustainable levels, given where house prices are at today. So that's kind of how I'm looking at things this week. I'd love to hear your comments in the YouTube section below. And as always, we'll see you next week.